What's up, y'all? My name is Karina Cook. I am a tax and financial strategist. I'm a CEO, a businesswoman, a faith-led businesswoman at that. What's up, y'all? It's your host, Karina Cook. Welcome to Evolving Out Loud. I'm so happy that y'all are here with me. And I have something, a treat for y'all this one. I know that some of y'all have partnered with someone. And I'm saying, like, even a partnership verbally or even financially. And some of us partner without really technically realizing what that truly means. Like, maybe you've helped each other out or moved some money around and started working on a project together. Then, boom, y'all basically created a partnership and doing this without even meaning to. And that's what I want to talk about today, because this right here is going to be what gets people caught up the most. And I've seen it time and time again. So I thought this would be a great episode to cover partnerships and what that looks like when you're getting in a partnership with someone. Now, you guys, what I want to get clear is that partnerships don't always start on paper. It doesn't usually, it's not always started with a contract. And I like to look at it like a lot of people just generally get into it. And I'm sure that y'all know the same thing because it happens time and time again, where it's just a natural thing to really get into partnership with people. And this is something completely different than just getting into a contract or a 1099 contract with someone where you guys are doing work or selling separate. Maybe this person has a company, the other person has a company, or you're working for someone and they're just paying you as a contractor. Some people call that a partnership, which it can be, it is. But this is not the type of partnership I'm talking about. This can be something that it actually can be informal. It can be something that happens just as a conversation, even through actions. Okay. It's not just moving money between you and somebody else, although it could be. This can also be, so the thing is that when there's money involved or equity involved, which is actual work being put in or something being put in, the IRS does not really care if this is something that is written or not. It's still a partnership. I get it all the time where I ask someone about their partnership and maybe they're doing something where it's separate, right? Where there's two completely different things, or we didn't form an actual partnership. Uh, we didn't form an actual partnership paperwork where it's legally showing that you're a partnership. We're just doing things where we are both, or we are four, or we are six coming together and we're splitting the business up or the project up. And we talk about partnerships, you guys, can mean one person, it can be two people, it can be three, four, five. And this is just an agreement that you guys have to make something happen. There can be partnerships formed in emails. There can be partnerships formed just casually sitting at the table saying that, hey, I'm going to go out and get this, and then you go ahead and do this. So we'll get more into that a little bit in the video because I want to explain the difference of what the partnerships, what happens in partnerships and how you actually form them and who's responsible for what. The question I would ask is, what would change if you start to talk about money and taxes before the money starts to show up? That's a question I want to pose because time and time again, this is something that happens when tax time comes. And people get real, there's a lot that happens, y'all, when partnerships are formed, regardless if it's formal or informal. The money is being talked about, but it's not being talked about enough in enough detail and in enough depth to really understand who's liable for what and what does that mean. That's kind of what I want to bring up, is talking about what that means when tax time comes. Because I think a lot what happens is people don't really realize that just because you didn't get paid doesn't mean you don't owe taxes. And it's sad because I get a lot of partnerships, and I've been having a lot more now than ever, where when tax time comes, it feels like, wait, I didn't even get any money. Why do I owe this money to the IRS? And let's say if I give you an example, let's say your business with your partners, you guys made 100,000, right? And let's say it's four of you guys, that's 25,000 each on paper. Okay. And if the managing partner who's managing most of everything says, look, we're putting it all back in the business, cool. And everyone agrees, right? This may be a casual agreement, maybe over dinner, or you guys are just talking about it, and everyone agrees to this happening. But when those K1s start to drop in, each person still has to report this 25K on their personal tax return. I like to look at this K1 like a W-2 for a business, right? It's not a W-2, guys. Just giving y'all an example. I don't want anyone coming for me in the comments saying that, oh, Karina. No, that's not what I'm saying. I'm just giving an illustration here. Let me give you an example. Let's say that all four partners, there's four partners in a business, there's 100K profit, and each partner gets 25,000 on paper. That looks good, right? But maybe the general partner or the managing partner said, okay, listen, when we make money into the business, let's keep reinvesting that back into the business to keep doubling it and keep investing it. So all of the money is getting back in the business. Cool. You guys casually agreed on it. It could be over dinner. It could be a formal meeting. It doesn't matter. But when those K1s drop, which is basically like a 10, it's like I like to look at it like a W-2 for an employee, but you guys get a W-2 as partners, right? It just shows what your income was. So then you're able to report it to the IRS, right? So partnerships don't get taxed. They show the income flows to the individual itself, the person, right? That four people, one person, that partnership income goes there. The partnership does not pay the tax on it. And I think that's what gets people confused. But with those K1s, let's say each person still they get the 25,000. This goes on their personal tax return. So even though the money never hits the bank account, the personal bank account of the partners, it shows that they made 25,000 each because they have split the partnership. Each person gets 25, 25, 25, 25. Okay. So that equals 100%. Now, that's what you call phantom income. Hey, y'all, it's your host, Karina Cook. Welcome to Evolving Out Loud. Make sure that you subscribe and hit that notification bell because you don't want to miss out. We drop weekly episodes and they're gems. So subscribe to the channel. And because nobody really talked about taxes in the very beginning of forming this partnership, this is the way that it has to go and work out, especially when you're in tax season and you pass the time where you actually can strategize. So that is a real big thing. And when we talk about the partnership, one of the things that happen is there's a 1065, because this is something I want to clear up. When people come in, they get really confused on how you actually report this. There's a form that tax professionals will file for you. And this is called a 1065. And shameless plug, please, you guys do not try to do a 1065 on your own. Go to a tax professional, okay? And because it gets really complex. But this 1065 is just reporting everything that the partnership did together. You guys can have assets, you guys can have loans, liabilities, and anything else associated with the partnership. It's reporting all of what you guys have together. Then you start to form K1s. A K1 is just showing like how I explained a W-2. Well, the K1 shows the W-2 for the partner, and it just shows what the partner made. So if we're splitting it, sometimes if we split it with two partners, we look at that 100,000, we split it with two partners, then each partner has 50% just to keep it easy. Then the person gets 50,000, another one gets 50,000. Percentages can be 80, 20. One gets 80,000, the other gets 20,000. Doesn't really matter. What matters is what the person is liable for. And this liability happens, you do get self-employment tax. With the money that shows to you as an individual, when you get this K1 and it shows on your personal side, you have to report this to the IRS. Well, technically it's earned income. We're just forming it and filing it very differently than we would if it was just you making business income as a sole proprietor or just one person. But typically, IRS you have to pay Social Security and Medicare taxes. Okay, that is what SE tax is. So, regardless if you're in a partnership or if you're in a sole proprietorship or if you are a corporation, there's just different methods of paying the self employment tax. So, each partner still will get this money and show that they have self employment tax and then still pay income tax on that. It just flows differently. Now, I think there lies the difference between having the partnership and having a understanding of how this is going to be managed with each partner. Now, you guys, not all partners are going to contribute the same way, and so we have to keep that in mind. Some partners might just invest, and that's what we call a capital partner. And a lot of people, capital partners are the best. And that is going to be different than when they're reporting certain things with their, and the capital partner reports it a little bit differently. And so some partners that are investing money, like we said, their capital. Okay. Another partner might just be putting all the work in. That's equity. That's sweat. You hear the term sweat equity, then there's probably going to be a silent partner, right? There's usually always a silent partner who is going to be there. Somebody that's not doing much. They're not doing much on the front end, but they're supporting the back end. Either way, everybody has written expectations or should have written expectations on who is responsible for what, who's putting in what, who's getting paid now versus later, and who makes the final calls. What does that actually look like? Is it one of us? Is it all of us? What does that agreement look like? And I think this is where the confusion usually starts to happen, because what when people aren't clear, and people think that they can be clear, but sometimes when you start to get down to the nitty gritty, they're not clear. They're just showing up, hoping for the best. And that's not usually how the business will work when it comes to partnerships. Before you start partnering with anyone, I believe it's important to get clear on these three things. It's going to be the vision, which is, what are you actually doing this for? And you guys, this is one of the easiest parts. I hear people say this all the time. Well, we've already got our vision, we already got our mission statement, we have this down. Great. The next thing you want to do is focus on the value. What is each one of us bringing in? What does that look like? Okay. What is the value in this, and how much are we responsible for? What are we responsible for money wise, time wise, and how does this look like? What does this look like on our taxes beforehand? Okay. Taxes is always the last thing people worry about, and I think it should be the first thing that people are really looking at. Taxes and legally, what is actually going to happen if things go wrong. People do not consider what can happen in partnerships where maybe you don't agree on something. Maybe someone gets hurt or they want to stop working, or what is someone's fair share, if, or what if someone wants to sell the business? There's many things that can happen in a partnership with partners that happen later down the line, and then you miss the mark, and then there's a lot of legal things that happen in between that you're not ready for. So the last thing I want to say is, don't skip that inner circle. The inner circle is having a lawyer, getting an attorney to make sure that these things are hashed out beforehand. Okay. You don't want to figure this out on your own. Talk about taxes, get advisory. And sometimes you don't need a full tax plan. Maybe you just need consulting on what this looks like for you on the tax side. You don't want to figure this out alone. You do need your inner circle, and you need somebody who's going to be able to see that excitement, because you want to be able to understand when you're in a position of these things, it gets really exciting. But you need someone who can see what your excitement can't see. Okay. And they can come to you and say, this is what it is. So, in conclusion, I want to let y'all know that I'm not against partnerships. It's actually a beautiful thing. But partnerships can be very powerful. But I believe it's powerful only when the purpose looks good on paper also. Okay. Because what's going to happen is structure is going to protect your peace. It's going to protect your profit. It's going to protect your health. And in reality, Sometimes it's better to lose a potential partner than to lose your peace or have stress later on. And so I want you to consider that when anyone's getting into partnership, what can truly happen, and really consult with your inner circle to see what the best options are for you and your partners, and how you guys can document this properly so that there's no surprises in the end. Now, y'all, this has been Evolving Out Loud, where we build wisdom. We are evolving out loud and we are doing it together. And if you aren't subscribed, please make sure that you subscribe to this video. And if this episode hit home for you, you guys share it with someone, like it, comment. And until next time, we are evolving and we are evolving out loud. Keep evolving, y'all. Exciting to say the least, and I'm happy that I'm doing it with you guys. Until next time, I love y'all and welcome to Evolving Out Loud.